Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to financing strategies with the use of permanent and temporary assets as a guide for our financing strategies. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 625 Financing Strategies, Permanent and Temporary Assets tab in the Practice Problems section. Closing this back out, we're going to have our information up top, then we'll have a smaller component of that information that we can use to work through the practice problem. So we have the current assets, we have the permanent current assets, and the fixed assets. Fixed assets is property, plant, and equipment, depreciable assets. The new thing here being the current or the permanent current assets, which sounds like kind of a funny term, a contradiction of terms. The current assets being something that's going to be on the balance sheet. Permanent current assets will not. We would have to be breaking that out to give us some more information about possibly our financing strategy. Those assets are going to be those kind of assets like the receivables or the inventory that, although they turn over all the time, are going to stay somewhat constant. They will be replaced by the next portion of receivables and inventory when we make sales and whatnot and purchase more inventory that we're going to be needing to make sales in the future. We'll also use this information to get to the temporary current assets, which those could be the assets that will change or fluctuate. We expect them to be increasing or decreasing possibly with changes in the sales volume that causes these differences or peaks in our current assets as well. So these are going to be used for our financing plan because we're remembering the accounting equation. Assets equal liabilities plus equity. We have to finance our assets that we're going to use in order to generate revenue with either liabilities or equity. We're going to be focusing in on the financing with liabilities here, and this will help us to think about whether we want the long-term kind of financing plan or a short-term financing plan. So we're going to plan to finance all fixed assets and half of the permanent current assets with long-term financing at 12%. So notice once we break this information out, then we could start to use it to gauge how aggressive we want to be with financing, how much we want to be financing with short-term versus long-term financing. The rest will be financed with short-term financing, rate 8%. The earnings before interest and taxes, $530,000, tax rate 35%. What other earnings after interest and taxes? So we have a smaller kind of recap of our numbers here that we can then use to work through the practice problem. So we're going to start off up top with the temporary current assets. We've got the total current assets were given to us. So the total current assets here, we've got the permanent current assets are the 460. Therefore, the temporary current assets are going to be the 530,000. Now, remember, in practice, we would have the total current assets from the balance sheet, and we would have to then, break out and figure out what we believe to be the permanent current asset portion and the temporary current assets, looking at the common or the baseline that has been set basically in the past, most likely, to figure out what we think is going to be a constant or what we think could be the baseline for the current assets. Then we have the interest expense. So interest expense can then be calculated. We have the long-term interest expense is going to be the loan for the long term. And it says here that we're going to take all the fixed assets. So that's going to be all of the fixed assets given here, the 730,000, and half of the permanent current assets. So let's break that out with the giant calculator. So we're going to then say that we've got the permanent current assets, 640,000. We're going to take half of that and then add to that the 730,000. That's going to be the amount we're going to finance with the long-term financing. Now, if you were to look at this, note that you might be saying, hey, we should be taking maybe the short-term financing for just the temporary current assets, and that would be like your baseline starting point. But then you can branch out from that point and try to see how aggressive you want to be from a measured standpoint by using these concepts of temporary current assets and permanent current assets. So we have the 600 or the 960,000. The rate is going to be the 12% on the long-term rate. That's going to give us a long-term interest of $115,200. Then we have the short-term expense, which is going to be 760 because we will assume we're going to finance this entire thing with a loan. So that means we're going to have the 990,000 plus the 730,000. So the current assets plus the long-term or fixed assets giving us the total of the 1,720,000. Then we're going to subtract out what we already took up top, 960,000. That gives us our 760,000 that we are going to finance with a loan on the short-term basis. So this is the short-term, typically the more aggressive loan, lower rate with it. More risk comes along, most likely, with that lower rate, possibly with fluctuations in the rate in the future, possible fluctuations in the rate in the future. So that's going to give us the 60,800. If we were to add those two up, the 115,200, the 60,800, we're at 176,000. 176,000 being the total. If we then take a look at our income statement, we're going to start with the earnings before interest and taxes, basically net income before considering interest expense and income tax expense. That's going to be our starting point. Earnings before interest and taxes, 530,000. Then we have the interest at the 176,000. There's the 176,000 up top. We will subtract that out. That's going to give us the earning before taxes, the 354,000. Then we have the taxes that we will then be calculating on it. That's going to be let's clear this out, the 354,000 times the tax rate of the 0.35. That's going to give us a 123.9. Then we have the earnings before interest and taxes minus the taxes gives us our net income, the 230,300. Now, once we have this information, we could start to adjust it if we so choose and use this breakout that we had up top between the permanent current assets and the temporary current assets as a guide to kind of help us to think about how aggressive we want to be with this information. So we might go into another scenario. Let's take a look at another scenario here. We have the same information. I believe it's the same information, except we'll have a change in the text here on how we're going to approach the risk, or how risk averse or how aggressive we want to be with the loans. So we've got the current assets, we got the permanent current assets, we got the fixed current assets. Here's the change. Plan to finance all fixed assets, all permanent current assets, and half of the temporary current assets with long-term financing. So we're going to be less aggressive here. We're going to be financing more with the long-term financing. We're going to base that to some degree on our information that we had when we broke out between the permanent current assets and the temporary current assets. The rate's going to be the 12%. The rest will be financed by the short-term financing, as we saw before. 8% is going to be the rate there. Earnings before interest and taxes, the 530,000. Tax rate, the 35%. Here's another breakout of that information. Again, the thing that really changed is just this item here telling us how much we're going to be breaking out between short-term and long-term financing. So we have the current assets are going to be then the 990,000. The permanent current assets, so we have the total current assets minus the permanent current assets, once again gives us that temporary current assets, and we need that term in order to know what our loan amount's going to be broken out between the short-term and long-term financing. Then we're going to be calculating the interest. We're going to have the long-term financing. Long-term financing amount is going to be the 1,455,000. That will be calculated. If we take a look at this, we want all the fixed assets, all the permanent current assets, and half the temporary current assets. So let's start with the temporary current assets. Here's the ones that you would think would be financed with short-term, if anything's going to be financed with short-term, right? Would be these items. But we're going to be more or less risky here and actually still finance half of them with the long-term financing. So I'm going to take the 530,000, I'm going to divide it by 2, and so the 265 we're going to finance with the long-term financing, plus we're going to pick up the fixed assets of the 730,000 and the 460,000 of the permanent current assets. That gives us the 1,455,000 that we're going to finance with the long-term assets. We're going to finance that at the 12%. Multiplying those two out, we get the 174,600. We then have the short-term interest that we're going to calculate. Similar kind of process. Now we have less finance with the short-term interest. We're going to assume we finance the entire thing. So we're going to say total assets then are going to be the current assets 990,000 plus the 730,000. That's going to give us the 1,720. We're going to subtract out what we financed with long-term financing, the 1,455,000. That's going to give us then our 265,000 that we're going to be financing with the short term. So then we're going to take that, we're going to multiply it times the short-term rate, that being the 8%, gives us the 21,200. Adding up the outside column, the two interest rates, we got the 174.6 and the 21.2. That's going to give us then the 195,800. 195,800. This being, more conservative or less aggressive. So we came out to a less. We had the 230 up top, and we got the. Well, let's look at the interest expense. We only had to pay the 176,000, assuming everything goes well, and in the more aggressive plan. And down here we got the 195,000. What will be the effect on the income statement? Let's take a look at that. Income statement, we're going to start basically at net income before interest and taxes, just like we did last time, given to us up top, that being the 530,000. Then we have the interest that we just calculated, the 195.8, which we pulling from up top here. That's going to give us our earnings before taxes, the 334.2. Then we're going to calculate the taxes on that. So the 334.2 times the tax rate. So we've got the 334,200 times the tax rate 0.35. That's going to give us the 116,970. And then we get the bottom line number here, the 334.2 minus the 116,970, giving us the 217,230 on the bottom line. Once again, if you look at the bottom line versus the bottom line up top here, and the last time we did this, the 230,000, a little bit higher earnings before taxes up top with the more aggressive plan. 217, the 217, 230, a little bit less here for the more conservative plan.